Stocks are on the rise today, putting the three major averages on pace to round out the week with gains following some volatility. Let's go to Tyler Ellegard. He's portfolio manager, Gradient Investments. He joins us now to talk some more about what's been going on. Thanks for joining us today.
Thanks for having me.
So we are seeing some weakness in the U.S. and in Canada. Job losses for July in this country, more than 40,000. Are you confident, or do you think equities will continue their upward trend?
I do. I think there's a bifurcation in how the market is performing, though, right? If you strip out the top 10 stocks in the U.S. S&P 500 or even the Mag 7, performance isn't looking as great, and earnings growth isn't looking as great, right? So as long as the top 10 names, which is about 37% of the S&P 500 right now, as long as those names continue to perform as well as they are with earnings growth, with revenue growth, with strong margins, as long as that continues to happen, I think they can continue to pull the market higher, just like we saw in 2023 and in 2024.
Okay. Do you feel comfortable with the tech sector sort of driving these markets?
I would rather see breadth, right? I think every investor would rather have every name in the S&P 500 or Dow Jones or NASDAQ working, right? But from a market concentration right now, they have to work. And if they don't, then it'll be a challenge. So I would rather see more breadth and more companies performing up to par with how the tech sector is doing. But that's not what we're given right now. And so we have to find the diamond in the roughs where we can. That's what we're trying to do, because there are names outside of tech that are working, but generally speaking, tech names are what's leading.
Okay, so how heavily invested are you in tech? Have you started to trim, considering where some of these stocks are getting up to? NVIDIA, of course, the big one people look to.
Yeah, we have been trimming along the way, taking profits and right-sizing our position, so we're not taking outsized risk in any one stock. But you have to be cognizant of how much weight those companies make up of the S&P 500, and know that if you do start trimming and those names keep working, you are going to be underperforming. And so we are trimming as much as we can, but remaining tied as much as possible to those names, because those are the names that are working. But also trying to find, like I said earlier, those diamonds in the roughs that maybe have been forgotten about. Maybe the names have performed poorly the last few quarters, and looking for a turnaround or whatever the catalyst might be for those. So we are looking outside of it, but yes, generally speaking, we are trimming those tech positions as they continue to move higher.
Okay, let's talk about earnings. You touched on this a little bit. You said they're not as strong as they could have been. Can you give me sort of your overall take on what we've seen so far with results?
Yeah, so generally speaking, for the S&P 500 here in the U.S., earnings compared to the 5-year average, their companies are beating the expectations more than they have over the last 5 years. The challenging part, though, is estimates have come down into the quarters, or expectations have come down into the quarters, likely because of the uncertainty of tariffs and the potential effects of them. But the companies that are missing their quarters are being punished by investors. They're down significantly more than they have been in the last 5-year average. So a company that misses on earnings expectations is down around 5% on their quarter versus down about 2.5% over the last 5 years. And the companies that are actually beating those expectations aren't being necessarily rewarded as much as they have in the past either. So the challenging part is companies are priced for perfection right now, with where valuations are at, with where the market has bounced back from April. So that's where the challenge comes, is if you do have that company that misses that expectation, they do get punished.
Okay, let's get to a couple of the stocks you're watching, your picks. Moodys is the first one. Why do you have a target on Moodys?
Yeah, look, private credit is a tailwind for this company. They need the ratings to happen, and that's right where Moodys sits. When we also start to consider recent potential regulation changes here in the U.S. of alternative investments being opened up to the 401k investment vehicles, that's a big tailwind, because even if you think about the $1 trillion plus that are in that 401k, even if about 50% of those investors put a 5% allocation into alternative investments, specifically private credit, that's a big tailwind for a company like Moody's. So there's a long-term growth trajectory for this company as private credit continues to be the new avenue of lending. And so we like Moody's in our portfolios going forward from here.
Okay, let's talk about Taiwan Semiconductor, because we had Donald Trump announce he wants a 100% tariff on semiconductors, on chips, essentially, that are not made in the U.S. So that's going to affect a lot of big tech. What's your forward gauge for a company like Taiwan Semiconductor?
Yeah, well, the good thing for Taiwan Semi is there could be an exemption for them because they have committed capital in the U.S. to building manufacturing plants. They're also expanding their current manufacturing plants. So there could be an exemption on that 100% for them, which would be fantastic. The other aspect of it is the recent quarter, we saw that how powerful Taiwan Semi is in terms of pricing. They can push through pricing. Companies are willing to pay up for Taiwan Semi products. They are the biggest manufacturer. And so I think going forward, our environment is so reliant on semiconductors, and regardless of whether they get the exemption or not, we're going to need Taiwan Semi to be making the chips that they're making. And so we like this company. We like their story. We like their ability on margins. We like their earnings growth. And I don't know that the 100%, it obviously is going to make an impact if they do have that 100%. But I do think President Trump, knowing how important Taiwan Semi is to the tech sector and specifically AI, I think they'll get an exemption.
I do want to get to your last pick, which is Alphabet. Tell me why you're positive on Alphabet moving forward.
Yeah, Alphabet is part of that Mag 7, but if you look at them relative to the other Mag 7 or the more specifically the hyperscalers, they've really lagged in performance, and valuation is quite cheap relative to the others, and also it's cheaper than the market at this point. And we saw their previous quarter beating on cloud, beating on YouTube, beating on search. Cloud obviously being the most important, but the turnaround story for YouTube is also very important. And so I think this company is relatively undervalued at this point, and a name that we really like going forward.
Okay, we will leave the conversation there. Thank you very much for joining us. We have Tyler Ellegard, portfolio manager at Gradient Investment.